details provide actual data with only the client names that are changed. While some of the assumptions, the outcomes are displayed, the actual work product itself cannot be shared until such time as we're engaged by you for our services. Going on to case study number 2, where we change the names to Eric and Jane. In this particular example, we're able to produce a tax savings of over $1 million and increase their wealth at 20 years by over $3 million. Eric is a retired engineer, and his wife spent most of her life as a homemaker. They accumulated a fair amount of assets, which are displayed on the next slide as well. Eric is age 66 and Jane is age 61. They have been our clients since early 2008 before the crash. At that time, the total investments were over $2 million, and he's done quite well between then and now. Even though he came in with $2 million just before the crash, he has over $5.4 million at this time with us. Eric gets a pension of $112,000 a year, which is not inflation adjusted. Jane started receiving Social Security at age 62 in March of 2019, just shy of $11,000 a year. And Eric started to take a spousal restricted benefit when he turned 66 in April. Although it's a meager $605 a month, it's still something to go into the plan. When we're using a 2.5% inflation rate on the Social Security, then he's expected at the age of 70 to receive $41,000 roughly in 2023, using that 2.5% inflation rate between now and then and with his deferral credits. His desired earnings forecast is 8% on IRAs and 6% on taxable for the plan. It's a little assertive for us normally, but since we've earned double digits for him since he came on board with us, we're okay using those numbers, even though it's more than what we typically might be comfortable with. He feels comfortable using 3.5% inflation rate on his lifestyle needs and medical, and his lifestyle need is $125,000, which is all inclusive of everything except for healthcare, which is listed there at $15,000 until the wife is age 65, and reducing that down to $12,500 when they're both on Medicare at that time. So the 20-year expected taxation for them under the current plan was over $3 million. And using our proposed plan, we are estimated to be able to get that down to $1.9 million, which is a savings of over $1 million in taxes. We have a pretty assertive plan in order to do that. And at the end of 20 years, again, we are not completely eliminating the IRAs, but we are reducing them substantially by over $6 million. The measuring stick is here. At the end of 20 years, we are able to increase growth wealth by over $1 million. We would anticipate having almost $13 million in Roth IRAs, reducing the IRAs by $6 million, and reducing the taxable account by $5.5 million, almost down to zero, but not quite there. And we would have a gross wealth increase of that amount. Net wealth is expected to increase by over $3 million. So based on all these techniques, here's the expectation. The net wealth to increase by over 20%. Here's a measuring sticks again. After 20 years, the expected lost wealth in the taxable account is $5.5 million, and the lost wealth on a gross basis in the IRA is $6 million. So the total lost wealth between these two less tax-efficient accounts is $11.6 million. The expected gain in the Roth account is almost $13 million on a gross basis. So that's an 11.5% gain in the Roth account in order to reposition those assets. So the rhetorical question is this: would you reposition your assets if you knew the IRS would pay you 11.5% to do so? That means that you'd be getting paid 11.5% to prepay the mortgage in the IRA accounts. On a net basis, the gain would be 33.9%. So the rhetorical question is, again, if you knew you'd have that gain of 33.9% on a net basis, would you reposition the assets? And lastly, if you were the heirs, would you rather inherit column A or would you rather inherit column B? And again, if you are able to stretch those distributions over a 45-year distribution period, which is what we're using in this case, using the life expectancy of their children in 20 years from now, this is the expected value of the stretches in this particular case for column A and column B. So please schedule a call with the tax planners now and let us discover ways to maximize your net wealth through our strategic tax planning. With our money-back guarantee, what do you have to lose? So please start your advanced financial freedom plan with us today. And I'm going to wrap up this presentation with a few myths. Myth number 1, taxes do not have a dramatic impact on wealth. Well, I think we've demonstrated that they indeed do. Myth number 2, there is nothing I can do about income taxes. Well, the truth is absolutely positively, there is something that you can do about income taxes, and that's why we're here. Myth number 3, I'll be in a lower tax bracket in retirement. When you start considering the double taxation that many receive in retirement, not for most of the people that we meet, they're not in a lower tax bracket, especially when you consider again that double taxation. And myth number 4, save in your 401k. Actually, we do encourage you to teach your children that they might want to save in their 401k. But they might want to also have an advanced financial freedom plan when they start hitting their mid to late 50s so that they can take control of their taxes when they hit retirement. They can learn how to turn the table on the IRS before it becomes too late for them. So lastly, please give us a call and let us help you discover ways that we can help you with your planning today. Thank you very much.